Good morning to everybody. Good morning to Marty, and good morning to the IvyFON crowd. It's great to see everybody. This room is packed today, and it's really wonderful to see. So I'm sitting here, I feel like, amongst celebrities, and it's great to be in this position. So my name is Mark Heil. I'm with Pacific Premier Trust. We do self-directed IRAs as the basis of our business. But out of that, we do a lot of work with institutions, particularly aimed at fund custody, aimed at helping people invest in retirement, using their retirement dollars into alternatives. So that's what we really focus on, and that's what we really do. This morning, we're going to be talking about manager selection, which is going to be very interesting, given what we just heard from the economist here and where things are possibly going. We're going to talk about investor appetites, perspectives of domestic, international investors, relationships between investors and managers, and ESG, obviously. Carol, that's one of your fortes, I believe. So looking forward to getting that conversation. So let's just push on here a little bit. For the next one thing I have to do, I work for a bank and a trust company, and many people are smiling. You've heard me before, but I have to read my little disclosure here. So let me just get this out of the way. Information presented is for educational purposes only, not as intended as advice. No tax, legal, or investment or any other kind of advice. Pacific Premier Trust performs the duty of a custodian, and as such does not evaluate, recommend, or endorse any particular investment opportunities. You're advised to consult with a professional advisor for your specific guidance regarding your investments. Investments are not FDIC insured and are subject to loss. I'll add one extra thing in here, and that is, to the extent I offer an opinion, I'm not speaking for the bank or the trust company. So they're my opinions, and not necessarily theirs. So a couple of months ago, I did one of these panels, and I had on a placement agent and an attorney on this panel, and it was a great conversation. But today we have three advisors, people that sit down with family offices and make the decisions on behalf of them. So it's going to be a little different of conversation, and I'm looking forward to getting that. What I'd like to do is maybe have our team, and I'm going to start with Matthew, since I've given him the least amount of airtime here. We can't see you, Matthew. Hopefully Marty's going to fix that. Is his camera on, Marty?
Hold on a second. Let me take a look.
You know what? That might be on my end. Let me just turn the camera on.
Okay.
Here.
It'd be great to see you. And I'm going to ask you just to introduce yourself, talk about Strata Analytics, and do that within a minute and a half. Just real quick background, if you would.
Yeah, sure. Is the camera on now?
Yes, we see you. Great.
Well, hi everybody. Yeah, Matthew Garrett here. I got by way of background. Currently, I've got a offering in the market called Strata Analytics. I work with family offices, some hedge funds, help them out with portfolio construction, really from a macro perspective. So think kind of like the macro research that Alfonso is doing, and then kind of porting that over to how do you shape a portfolio around it. Further in the background there, I started off in the industry in leveraged finance, lower middle market, came out during the after the financial crisis. So that kind of threw me right into the tail end of a distress cycle, which was very educational. I was more of a macro guy at the time, but I got thrown into senior, basically a portfolio of senior credits for deals that were underwritten during the height of the cycle. And that gave me a whole new appreciation for how important capital structure is, how important protection is, and also where you are in the cycle. Like Alpha saying previously, European credit, 7-year credit at 300 basis points, that actually works for a few years. As rates are going down, as this cycle's benign, you got to be in that. That's market. It's just about when the music stops, you have to be more thoughtful. You got to be a little bit more tactical. And also, I'll repeat what he said. Optionality is very important. So having a big cash buffer. So I work with the family offices, manager selection, portfolio construction, and then also doing some overlays, idiosyncratic trade ideas. I will think about stuff, think about things that lawyers have told me in the past. So all this is conversational purposes. Nothing should be deemed a recommendation to transact, invest. Purely conversational purposes, call it market intelligence. But that's the background.
Fantastic. Thank you. Carol, would you do us the honor?
Surely. So hello, I see a lot of familiar faces in the room here. My name is Carol Pepper. I'm the CEO and founder of Pepper International. And for the last 22 years, I have been setting up family offices all over the world. I've set up family offices on 5 continents. And I act as the external chief investment officer to several large single family offices with a focus on impact investing. I do talk about the markets about once a month on Bloomberg. I was on this last week, and where the economy is going and what it means for wealthy families. And I think, this is a very interesting time, particularly in New York. We have a lot of real estate based families who are asking a lot of questions about where are we in the real estate cycle? What does this mean in terms of how much cash I have? Where should I be putting it? Should I be holding it back, et cetera? So I think, we're in a very, very interesting part of our cycle here for the family offices, which are naturally more conservative and are poised and trying to figure out where should we allocate funds. I think there's also been a massive uptick in the requirements, particularly in Europe, Middle East, to look at the social and climate, particularly climate impact of a lot of investments. There were a lot of new regulations actually passed in the European Union in December, which are going to be affecting all companies in terms of how they measure their carbon footprint and what that does to their stock prices, what that does to the value of the commodities that they're trying to import into the EU, et cetera. So lots of things to look at in terms of how the regulatory environment is going to be affecting manager selection and prices of assets going forward. But I basically always work with family offices. I'm very involved right now in the climate side of things with carbon credits and families that want to create carbon credit projects. So I think we'll have a very lively discussion. That's a very new emerging asset class that's going to be huge, I think, in the next 10 to 20 years.
Could you maybe in 1 or 2 sentences just distinguish impact from ESG?
Well, impact is sort of the cool term these days for ESG. I'm not sure that the terms matter particularly one or the other, but I would say with impact, there's an attempt to measure with some sort of a metric exactly what is happening as regards to something you're doing. So are you measuring how much carbon you're spewing into the atmosphere with your operations? Are you measuring how many CEO or how many female employees you have? Are you measuring wage parity amongst workers? There's lots of different things that you can measure. And so with impact, generally that people are trying to actually measure things. And we're often tying those measurements to the SDGs, the United Nations Social Development Goals. And again, particularly outside of the US, people take this extremely seriously. And major corporations now also issue, in addition to their annual report, their social impact report, their SDG report, and their climate report, because climate is becoming a much bigger issue for all of the corporates, which will affect how we invest as family offices.
Terrific. Thank you for that. Peter?
Okay, so I'm Peter Plaut. I'm honored that Marty invites me to these things all the time. Usually I'm doing them from a TV like that in my boxer shorts because my wife doesn't let me out of the house because I have 6 kids. I have 3 girls, 3 boys, 2 sets of twins. People, I live in London. I've been there for 20 years. People stop me in the street. They say, "What accent is that?" This is from fucking Brooklyn. I'm from Brooklyn, New Jersey. It's unbelievable. My kids don't know what language I speak. So I definitely don't have a British. I definitely don't have a British accent.
That's better. Yes, right there.
So But no, I've been in London for about 20 years. Been on the sell side, the buy side. Last 5 years at a large family office. Currently, I am advising family offices, very similar to you, on a couple things. Originating private debt deals real estate deals, raising capital for them if it's a single family office and they might look for a partner. Most important thing is impact. I'm not talking about ESG, but really just as an advisor, trying to be impactful to the family offices that retain me in terms of asset selection, finding the right opportunities for them. Last week, I had the opportunity to speak on the floor of the NYSE. We spoke about real estate investing, we spoke about art, we spoke about ESG, impact investing, and in particular from a family office angle. So one of the things I like to look at in terms of asset allocation is I get asked about, look, I'm not an advisor with 300 people like some of the larger ones, but I grew up for the last 30 years with most of the large private credit guys that were analysts and now running those firms. Same thing with private equity. So they asked me for the inside scoop. What do you think of this manager? What do you think of that manager? Not just based on performance, but the research team, the portfolio team, how they've gone through cycles. They have a seasoned staff that have gone through the cycles from the tequila crisis in '95, the Resolution Trust Corp back in the late '80s, always the global financial crisis, and how do we deal with that, particularly as we come into this environment. So hopefully I can be impactful to everybody on this talk today.
Well, I'm going to give you the lead off question here. So how about that? Peter and I are doing a panel tomorrow on direct investments, which is going to be a great, for family offices, which is going to be a great discussion. But I think one of the things I'd like to really think about for a couple of minutes here as we begin our discussion on selecting managers is, when does it make sense for them to do direct investments, and when does it make sense for them to hire managers? How do you see that? How do you think about that?
Well, first of all, I like to look at it from an asset allocation decision before the management decision. I'm looking forward over the next, call it 18 to 24 months. We just heard a great economic overview. And if you look at the private equity world, for instance, it's not going to be the year or next 2 years for private equity. Private equity is based on a small amount of equity and a lot of leverage. The private equity firms are not going to be able to get the leverage that they're used to. So deals are going to have a higher equity percentage, to be lower debt percentages. That means the IRRs on the models that they do just are not necessarily going to work. If they don't work, then they're not going to get the returns, and then you're going to see a shift, a really big shift from the pension funds and others that are allocating to private equity. They might be overweight their benchmark by accident. They're going to have to reallocate. So I think the next 18 to 24 months is going to be focus on private credit, and you're going to see a significant amount of capital being reallocated to private credit, direct investment. Right to your point, we're looking at a family office. If you're looking at something like MSD Capital, I mean, you're looking at an institutional quality with so many analysts, et cetera. They do their own private debt deals, no different than a credit fund like BC Partners or Fortress or Ares, et cetera. When we get into single family offices or even multifamily offices that might have 3 or 4 analysts, okay, covering stuff anywhere from public equities to public debt, investment grade, high yield. They really don't have the ability to focus on private credit, because to be an investment in private credit, I'm talking about a direct investment deal, you really need to be close with management. It's weekly calls, if not daily calls, particularly if you're looking at a debt or equity investment. If things to get into trouble because of the economic cycle, you're not calling up Houlihan Lokey and basically saying we're in a distressed situation. You want to work with them, particularly as a family office. So you're going to be working with them. So you need to have those resources. So if you don't have the resources and you're really not focused on just private deals, I'm talking away from real estate, I'm talking about just private credit deals, then you really should be looking at an asset allocation to private credit. And that's where people come in and ask me, which manager would work, basically.
Sure. And I think that's very helpful. Carol, did you have anything to add to that? Again, the question we were looking at, the question we were focusing on was, when does it make sense for them to do a direct deal as opposed to selecting a manager?
Yeah, well, I think managers are good when you don't know anything about the area. When it's a new area, your family office, for example, has never invested in this type of area. It's very smart to go with a manager as a start. Also, the size of the investment. If you have a small amount of money to invest, there are people who, for example, next gens where we're trying to learn Direct investment, we can go into small and sprinkle around $50,000 or $100,000 in various seeds to see, and get our feet wet and understand direct investing. But if it's not something your family office has been very familiar with, you're very well advised to start small on direct. And many family offices do. They'll, let's say, put in 50 or 100,000, maybe $1 million into direct, and then build up slowly as that particular investment matures and does well. So family offices are fairly conservative that way. If you're looking at an area you know nothing about but think it's going to do very well, let's take China. Let's say you actually are a China bull and think they're going to recover. You're much better off to try to do China via a fund than do China via a direct investment, as an example, or even European deep tech. Unless that's your area and your family has grown up in that area, you're much better off working with managers. So familiarity, size, and then within each structure, whether it's a trust, a long-term trust for a generational skipping trust, private trust company, personal account, the size of the investment should be inside an asset allocation that makes sense for the particular vehicle. So it's not like we have one asset allocation for the family office. We need to have an asset allocation for each vehicle that makes sense with an investment policy statement first, then, cut everything up into buckets in terms of how much in equities, how much in debt, how much in real estate, how much in directs or privates or funds, and then go into shopping for particular funds. So you put your shopping list together first in terms of size, and then you determine whether it's a fund or a direct opportunity.
Terrific. Matthew, I'm going to come your way here. On your site, you talk about predictive insights on risks and opportunities. And this morning we heard about a very changing economy. So I want you sort of to talk about, what are you bullish on in the next few years in terms of strategies, maybe domain areas as well, and then finally geographies. That's a loaded question. I'm sure everybody's going to have an opinion in the room, so I'm hoping to hear from a lot of folks.
Sure. Maybe I'll pick up where the last guest left off and maybe augment or add to kind of the synopsis of where we are and how we got there. So where we are, I think there's a lot of good kind of real-time metrics brought up in the last presentation, but I think there is certain structural underpinning that explains some of those metrics. It will kind of paint the picture of where opportunities are, where they have been, and why you might have made some of the decisions that you could have made in the last year and a half. So I think in our intro call the other day, I mentioned I was socializing an idea or kind of a question to a number of the groups that I talked to. And that question was the end of 2021. And I asked, what was the most crowded trade in the world? A lot of people said growth equity. A lot of people said, maybe like directs at the time, maybe it was VC, earlier stage VC. And those were all real estate, and those were all correct answers, but each one only made up about, let's say, 10% of the total right answer. The right answer, in my view, was the most crowded trade in the world is short US dollars. And that basically means if you have leverage, you're probably borrowing USD, or you're borrowing something that closely approximates USD. And in that world, in that construct, you are short US dollars for the asset that you bought or the future flow of cash that might be a terminal value at the end of 10 years, which is kind of like your growth equity view, which will be burning cash as you get to that terminal value, which just enhances or magnifies your short dollar position. So you basically had the whole world short US dollars as central banks made it very conducive to borrow, made it very cheap to borrow, and everybody pushed out the risk curve. So that was like your backdrop and kind of building conditions building to this mega short US dollar position. So what was the right thing to do in that situation? Do we have an immediate catalyst? Because I could have made the same argument 2 years earlier. And what was the immediate catalyst? You had some global geopolitical tensions, China trying to assert itself a little bit more on the world stage, energy producers asserting themselves a little bit more on the world stage, which kind of tugs at the underlying funding mechanism for those that provide those cheap dollars. Long story short, that's kind of a quick synopsis of the underpinnings. But what does that mean from a portfolio perspective? If the world is short US dollars, you want to have a stockpile of US dollars. So I started going to them and saying, hey, let's look at the kind of first, what are the most susceptible assets that are at risk if I am right? And those were the growth equity, obviously far out on the risk spectrum was cryptocurrencies. And really what you can kind of do is you can look at everything that was invested in like the previous 2 years or the most recent. And that would be kind of like, think of it, last in, first out kind of scenario. Later stages of the cycle, most vulnerable. So that we saw initially in 2021, we saw SPACs, IPOs, crypto, all really get hit before anything else got hit. Then it wasn't later on until 2022 that you started to see the quality tech names start to get hit. And then kind of more broadly, you saw it move, spread, metastasize through the system, where even basically everything beyond, let's say, like certain areas of staples, kind of like even, you know, some areas of utilities, but the one standout area was industrials. Industrials did well because part of that geopolitical shift revolved around the US onboarding more production. So there's like this kind of one-off tail risk. So we started looking at industrials, even like single names, and they have done exceptionally well as the rest of the world, you know, investment world has done pretty poorly. And that was kind of a secular trend that you could ride as this broader, the broader environment got more restricted in terms, or you know, more of a headwind for the broader environment. So that was the past. Looking forward now, it's like, what can you, like, what do you do? What does the environment look like? I think cost of capital most likely stays high. I don't think you'll see the large credit creation. And I think you're going to see, really, my new theme is dispersion. You're going to see extreme dispersion. And that's going to be very challenging for family offices or any large institutional money managers, where you were worried about underlying credit dynamics hitting parts of your portfolio. How do you hedge that? You could buy like CDX. The problem is the CDX is going to be made up of it. There's going to be selection bias in there. Those are going to be very highly performing liquid names that may not get negatively impacted. Therefore, your insurance policy might not hit on those. So you're going to have kind of, let's call it, out on the periphery, 20, you know, maybe make a number, 5%, 20% of credits that start to become stressed, but your avenues for hedging it, you're not going to have many avenues for hedging it beyond trying to take down the risk in those most at-risk names. And then that's just sitting in cash, getting along the option that Alfonso talked about. And then you can deploy that to distress managers and hope to see a re-rating a lot of these credits and get in there.
That's terrific. Thank you for that. Peter, I want to come back to you for a second here, because he said a couple things that, you know, he mentioned industrials, which obviously would be a driver for private credit and things of that nature. He also spoke about, you know, the shorting the US dollar and now maybe going long on the US dollar.
It's actually the
this?
reverse. It's a reverse on that. So there was
Reverse,
too many short, say the dollar short squeeze and the dollar rose.
Gotcha. So how do you view that in light of private debt?
First of all, looking at it from sitting in Europe, right? The UK is an unmitigated disaster. Okay. We talked about some in the last session about floating rate mortgages, etc. It's not that the banks aren't healthy, etc. It's just the economy is quite bad and will continue to be so. And that permeates throughout most of Western Europe. So US dollar assets are still the most attractive in an asset allocation decision. I would say if you're looking at the bigger private credit funds,
We need to keep you in the picture.
Move a little bit over more.
Yep, sure.
Right there.
There we go.
if we're looking at the private credit funds, for instance, most would basically say there's more opportunities over the next 18 months in the US than there are in Western Europe. So we continue to see more of an allocation to US assets. And again, I'm focused strictly on private credit. In terms of, whether you're taking a strategy in terms of industrials, technology, whatever, That again is going to be dependent on a case-by-case basis, depending on, as you mentioned, in terms of where the expertise is among the family office and the analysts that they have there. So you can't basically just say, oh, we're going to overweight industrials. So I don't look at this economic situation, and I've lived through 3 decades of that, as anything different than past economic cycles. And in fact, we talked about 3% mortgages, 4% mortgages. The normal interest rate, okay, for most, whether it's a residential buyer on a 30-year mortgage, et cetera, was 7 to 9%. If you look at LBOs that took place, it was always in the 9% plus level. So we got used to a situation over the last 14 years or more of very low single-digit returns. That's not normal. So what I look at when people ask me, how do we look at proposals? Do the companies that you're investing in, if we're looking at it from a direct investment point of view, okay, do they have the ability to operate profitably under a higher interest rate scenario? It also goes into, can you do bolt-on acquisitions that make sense in the current environment, because leverage is going to be much tighter. So all I'm saying is US dollar assets are favored. Private credit is favored. If you don't have the expertise in a particular sector, and you do the manager allocation, you try to figure out, as you rightly point out, which manager is a particular expert in a particular space. I'm not looking at this cycle as my background is distress, okay? I'm not looking at in the US as a massive distress opportunity. It's not happening. The economy is doing okay. The Fed will manage it slowly. But if you have an environment where there's less leverage that's available, you might see in, for instance, the real estate states, a lot of people just handing the keys back, simply not because they're default, not because of 2008, simply because the math doesn't work anymore for the returns. We're already starting to see that with some of the larger REITs putting up the gates, etc. So we're seeing that already.
Kelly, you want to chime in and talk about the real estate market a little bit?
Yeah.
Where you see the opportunities currently and where there are areas to avoid.
Well, I think real estate is holding its breath right now in the United States. Let's just talk about the US. Everybody's sitting here going, what is the Fed going to do? How long can we hold out with the portfolios that we have? People that I know that are multifamily owners, for example, are saying that the credit side has basically died. The credit has dried up. The math is not working on a lot of the multifamily properties. The folks that did well and sold at the end of last year are very happy, and they're sitting there with a boatload of cash, but they're not yet excited about what's available. Same thing with commercial. People are holding their breath a bit about where people are moving in the United States, what's going to happen with New York and the commercial side, and not only New York and other places. Are they going to be able to force everybody back to work? I personally think that's part of the Fed, putting the squeeze on the market, is to force people back into the offices and into a more traditional working arrangement so that they can keep the buildings occupied, so we don't have a massive crash in commercial real estate. Having said all of that, there are some very interesting areas. I think you have to look long term. You have to say, what has happened over the last couple of years that will continue to happen going forward in the next couple of years where we can make money? Things like defense. Okay, the defense budgets have ballooned. Nobody's screaming anti-defense. So any real estate, I know folks that are developing real estate, for example, for defense contractors, they have 40 years worth of backlog and they have lots of people in their buildings and there's no problems there. There was a massive climate and Inflation Recovery Act passed. There's massive tax incentives that have come towards solar energy, toward RECs, towards lots of different areas that will affect real estate very positively. So let's look for where you can make money and where the trend is going to last. So defense is going to last. Technology is not going anywhere. Yes, they're taking this advantage to lay some people off, but the truth of the matter is the US tech dominance is not going to end. Onshoring is going to continue to happen. Manufacturing is going to continue to be built more in this country. Supply chains are going to go vertical to sides of the world. So LATAM and Mexico up to the US and from Canada. That these things are secular trends that we can hold on to for the next few years. And that's where we need to focus. For people that have the opportunity to take some money off the table, it's not a bad time to take some money off the table, because over the next 2 years, there will be very much distress situations, whether in private credit or in real estate, where you're going to be able to buy stuff for a song. I mean, I know families in Europe that are shopping happily for hotels in the United States right now because they have a 10 or 15-year time horizon. The joy of being with the family office crowd generally is that we have a long time horizon. So we don't want to just look at the next 2 years. We want to look at secular 5 to 10-year trends, keep our powder dry to pick those opportunities, because there are other people that kind of over levered themselves, and they're in that tricky spot, whether it's on the commercial side, certainly on most of the real estate. They need to flip, or they did their construction loan, now they need to flip. They can't get that second level of permanent financing. So there will definitely be opportunities to make money in real estate going forward. I think multifamily is going to continue, and I think single family is going to continue to stay frozen at these rates. Because think about it, the average American now can only buy half the house they could buy a year ago, and that's a pretty bitter pill to swallow. So they'd rather stay put. They're all hoping that the rates will come down as well too. So I think you'll see the single family rentals, the multifamily rentals continuing, and people kind of holding on to their real estate, not wanting to sell at a price that they don't want to sell at, because the buyers can't afford the price that they could have afforded a year ago. So, yeah.
I just wanted to pivot a bit. I've been financing for the last 10 years real estate across the globe, and over the last 30 years, I've been doing distressed real estate. I mentioned in my last comment that I don't see a distress cycle in real estate here in the US. But in Europe, there's a very big situation coming up, which is carbon neutrality, which is only 7 years away because it's mandated by 2030. The EU regulators in the UK may push it a bit, but Germany and the UK are pretty solid. What is carbon neutrality? Basically means if the building isn't up to compliance, you can't lease it. I'm talking about office buildings, but also we can talk about residential. So what does this mean? We're going to have a massive amount of stranded assets, which are Class B, Class C buildings across the UK, across Europe, that people are not going to lease because they need to be upgraded, ESG compliant, etc. So on top of the fact we're going to have higher rates and real estate slowing down, now we're going to have significant amounts of hotels, residential, office, they're just stranded, just sitting there on banks' balance sheets, sitting there, and nobody's going to take them. If you want to knock down the building to reposition the building to something else, you can't, because the carbon footprint is going to be worse than if you just try to reposition. There's going to be a lot of opportunities to reposition buildings there and get them on the cheap, and significantly cheap. So there's going to be a big wave of distressed real estate in Europe because of this carbon neutrality dictated by regulators, not necessarily because of the economy. And that will lead into the ESG thing. But one thing that you mentioned was technology. I want to mention, I advise a company called Branded Strategic, and they're based here in New York. They are basically a private equity firm that invests in hospitality, mostly the food and beverage, but also focused on just operators. And after what happened with COVID, and all this, the F&B being basically slaughtered, seeing a tremendous amount of interest in technology and helping the food and beverage industry, the hospitality industry. And you just walk the streets here, walk the streets in Europe, Miami, wherever, hospitality is coming back massively, both from the hotel side, the food side, etc. So I think there is an interesting trade in terms of hospitality space and hotel space, whether it's direct investment or it's into a private equity fund that invests in these smaller operators focused on technology, green tech, clean tech, all the other things as interested in this private equity fund.
I think we've seen every down cycle, good companies still get done.
Yeah.
If it makes sense, you can turn a profit in this environment, and it makes a lot of. Marty, I see your hand up, so.
Sure, I actually have a comment about real estate, about Brookfield defaulting on 2 loans in LA yesterday, right? But we're not gonna talk about that. We'll talk about that in the real estate panel. But I was hoping that people here could discuss, the outcome of FTX's failure and FOMO and manager selection, right? Because a lot of people I got to get into this fund, and just because one crypto fund did really well doesn't mean they all do well. Same thing, a lot of other stuff. So, can you guys talk about due diligence a little bit? Because I think, there's going to be some scrutiny from the SEC, which is now investigating this relationship between the twins and Barry Silbert and this lawsuit, and they're going to be examining all their email transactions, et cetera. So maybe you guys can talk a little bit about, due diligence in terms of Has there been a bunch of, when we had this, lots of easy credit, was there lots of FOMO, in the manager selection, and is that gonna change now?
Well, I think just in general, if something is too good to be true, looks too good to be true, it is too good to be true. That has never changed. You have to look and consider the source of your, if it's a crypto bro that you snorted a line with at a conference, that's not necessarily the best person to buy a fund from. If it's some Instagram model who's like leering in your face, that's not necessarily at the cocktail party the best person to buy a fund from. I think there was a lot of scorn among the crypto guys toward normal investors saying, oh, they're just old schools, fuddy-duddies, they don't know what they're doing. So, for family offices, it's very, very important to have a funnel, particularly with the next gens, because often it's not always, but often it's the younger people who just, roll their eyes at the family office and say, oh, you don't know what you're talking about. I'm putting money in here and I'm going to Venmo it to you right now. Here's $1 million. So, I think due diligence is always important. In a downturn, it's even more important because people get more desperate. And also, there's a lot of better scams out there today. We thought Bernie Madoff was a great scam. I remember when I was at that time, I was at the Rockefeller family office. We were looking at the very first hedge fund investments for the family. And when he got offended, when we asked simple questions like, who's your auditor? We showed him the door. We said, thank you very much. We're not interested. So going back to old school stuff like, who's your auditor? Look at what's happening with the Donnie, who is, how are you making your money? Calling references, asking if other families are invested, calling those people. It's not foolproof, but the old school, picking up the phone and calling people, not just relying on what's on social media or what the celebrity says, who's backing the fund, who's getting paid to do that. All those things are extremely important.
You talk about like red lights, like I'll give you a great example. Like a guy came to me, he was asking for like $30 million and he didn't have a website. Weird, right? Like if you can't find something on on the internet, it's probably somebody you might want to avoid, I think.
Well, I don't know about you guys, but I get 10 million approaches on LinkedIn these days and direct messages from people I've never heard of because I have a LinkedIn profile, and worse, I'm on television. So I get a lot of, I probably get 500 to 1,000 queries a week, literally. And I would say most of them I completely ignore because I don't know anybody who knows them. I'm old school. I like to pick up the phone. The family office network is very reliable. A lot of us in this room have known each other for over 20 years and we trust each other. So it's really important. This is to the younger people that we start developing that network and talk to some of these old folks you see in the room, because actually we've been around the block a few times and we actually have very good networks to vet people. It's also important if you're going to put a really serious chunk of change into something to call a wonderful company named Kroll. Kroll. They are largest security firm in the world, and they will background these people before you give them your money. I'll give you a brief story. There was a kid that I knew who wanted to put money into a flying car situation. His mother was very nervous. So rather than just saying no, because he was, rebelling, we said, okay, let's just have Kroll. You take some of your money that you want to invest and go call Kroll, and let's background the people in this flying car situation. And sure enough, turned out to be a scammer who had been sued multiple times, had changed his name multiple times. And so we absolutely were able to save that family member from making a big mistake. So, there is truth out there. Sometimes you got to dig for it, and if you can't personally dig for it, you need Kroll, because that's what they do that for the U.S. government. They're the best. The best guy there, who I love, is Tim Horner. Anyone who needs to talk to Kroll, contact me, because it's the money well spent. For 10 or 20 grand, you can cut through a lot of stuff. Do not give your money to people you've never heard of without calling Kroll to background. That would be my number one piece of advice on that.
Should I have that number? Because those Instagram models keep hitting me up. It's been my third wife by tomorrow.
I think your wife will be glad if I give you that number.
Yeah, and that had a hard stop. But so another question is, if somebody comes to you looking to raise like $20 million, like they're a venture, shouldn't they know something about the market? Like who's their competitors? Stuff like that. I mean, guys come to me all the time, like, oh, I'm looking to raise blah, blah, blah money. I'm saying,
Well, I
well,
think
who's your
one
competitor?
of the other
What's the
things
space?
is beat the deal, right? And good markets, the compression time on due diligence and all that gets squeezed way down. And in bad markets, you have all the time in the world,
There you go.
So if you want to get into KKR 3 or 23 or whatever the number is, tomorrow, right? Now, Now maybe they can wait it takes a couple months. People are gonna do their homework, and KKR is probably a bad example. It's the second tier, third tier of these funds that are out there.
Yeah.
And I think that's what happens a lot. That compression time really gets narrowed. You see it on, in directs, we'll talk about this tomorrow, I'm sure. On the direct deal side, a year ago, 2 years ago, you didn't sit down at the table and write a check immediately. You weren't getting the deal or giving them an LOI at least.
Question?
What does the panel think about feeder funds as a way of having a filter towards a portfolio of different funds that otherwise would take up too much of your capital?
A lot of feeders, unfortunately, were how Madoff scammed a lot of people. So you have to look into the economics of the feeder. A lot of people are promoting feeder funds just because they get a huge upfront cut. So, like everything else in this world, it depends. But you have to be very careful. Some of these feeders are just pure promoters who get money, and they might be not the best fund underneath it. You still have to do your due diligence about what's underneath the feeder. That's the most important thing. Yeah.
So feeder funds into a fund or feeder funds where they're co-invested into a deal?
No, I'm thinking about feeder funds that are a portfolio of various funds.
It's just
So
layers
it's
of,
almost like
it's
a
layers
mutual
of
fund
fees.
of
It's like a
type.
fund of funds, really.
Right.
It's really a fund of funds. So it's another layer of fees that you're having to pay. And again, the question goes back to what is the sector? If it's something like, let's say, deep tech, right, which is very obscure. I have no idea what those people do. But if you want to get into it, you might be better in a situation where there's 10 of them instead of one. But then who's running that? Who's running the fund of funds selection process? So it could be good for, I'd say, obscure areas, but it can also just be a lot of, you have to add up all those layers of fees. They rarely tell you what's the total after fee, left over for you. And that's where you can, lose a lot of money.
I will tell you that I'm seeing a lot of right now, and we deal with RAs a lot in our business, where they are, forming their own SPVs. They might invest it in a number of different funds for people that wouldn't be able to access those funds otherwise. And for that situation, it can be very good. But again, Carol's warning's right up front. Absolutely right. You got to know who you're dealing with. You got to do your due diligence. Peter, any thoughts?
Yeah, I would, simply is, you saw a massive shift if you look at what went on in the SALT conference over the last 14 years from traditional asset management all the ways into the entire thing became focused on crypto, blockchain, etc. And some of the feeder funds and others that were there, I'm not saying they didn't do their homework, but they just went for the trend. And there was no differentiation. So the dispersion didn't become any dispersion. It was strictly right into where can we put our money, which funds are there focused on crypto. They all got blown out of the water last year. So I'm not a big fan of feeder funds unless you really know them and they do their research really well. I love the company Axia because they do great research. They have 300 research analysts at Axia globally looking at different funds, and their clients are all the big pension funds, etc. They do great work. I'm not advertising them. I'm saying they're a research group, right? Not an allocator. I'd rather spend my money on asking somebody like that and spending the money there, and then figuring out which fund I want to invest in rather than a feeder fund.
Right. I would agree with that. I would think institutional quality in funds is going to become more and more important today. There's a lot of people that want to create a small fund, and God bless them. But in a risky down market, the muscle is with the institutions. The ones that are going to hear that a particular company inside a fund is in trouble early is the institution who's given that fund $100 million, not the small fund, startup fund. So also access to information tends to be a lot better when you're with more institutional quality managers. So in a down market, you want to go up in quality, you want to go up in due diligence, you want to go up in security checking. All those kinds of things are going to protect your money. Otherwise, just sit in cash, okay? The street is always trying to make family offices invest. There is nothing wrong with sitting in cash until the opportunity feels really right for you. Don't feel pressure to invest just because, or as Marty says, in a FOMO situation. It's not required of a family office. We're not in that kind of situation.
So when you look at a market or you're analyzing a market, how do you distinguish between the next great thing, the Googles of the world that come on out, and those that don't really have the economics.
It's hard. I mean, for example, I would say the next great thing is climate in certain respects, because as we heard from Peter, this is really happening, particularly outside of the United States. Laws, rules, and regulations are being set down. So anything related with climate measurement, improving buildings, improving systems is going to start to make real money. The carbon credit market, anybody who wants to know about that, call me, message me, because that's something I've been looking into very deeply for some family offices. That's going to be very real because it's connected to regulations. When you're looking at something like crypto, unfortunately, where the regulators don't want to touch it, or now they're going to squash it, or it was trying to be ex-government, that's the kiss of death, in my opinion, because nothing can be ex-government. Why? Because the government has the guns. The government has the military. So at the end of the day, to think that the government's going to allow money to move around the world with absolutely no oversight and let that become a large part of the economies of the world is completely a fantasy. They have the guns. They will stop it.
It was interesting because you mentioned the credits,
2 minutes.
carbon credits. Okay. And I got a call from a fund once saying, how do you value those?
Oh God, I could give you like an hour on that. We don't have time today, but I will say this. There've been a lot of fake carbon credits. There've been a lot. Why? Because there wasn't a strong regulation. Now the CFTC is going to start regulating carbon credits. That's a good thing. In Europe, they're going to be regulating carbon credits. There's much better ability to measure carbon capture today than there was even 5 years ago. That's a good thing. So you want to go for things where the measurement, the calculations, and the regulation is your friend. But again, there are very many fake carbon credits out there, and don't get me started on carbon credits that have been tokenized, because you'll hear me talk about how that's really a recipe for disaster. But
I want to
talk for another day.
throw the last one out.
Carol, you got Matt Garrett here.
We got Matt.
Real
Oh,
quick.
Matt, you're perfect.
I'm
I
back.
didn't think you were here. You don't mind, I'm going to throw you this question. It's one that Blake is throwing at me more than a few times here, and it goes back to the due diligence. And I think it's perfect for you. There are a lot of great analysts out there who write great research papers, but struggle to deliver, performance when they become the CIO. How do you assess the portfolio management skills of somebody who's stepping into that role, and how much weight do you put on them?
Yeah, I think that is incredibly critical. I think a analyst, a risk taker can't deviate for too long from the pack, just because of the embedded career risk. They're gonna generally make a couple of big calls here, but it's like when they're going to deviate from the pack, how do they express that view? Or how do they find the convexity? How do they think about it tactically to deploy? I think there's a lot of famous guys that I'll call them kind of like the long vol guys in the world that have made very big, they've had years with huge returns, eye-watering returns, 200+%. But the problem is those guys will typically bleed out 20-30%, per annum. And just it's when when they hit that one, that 1 in 50 that's priced like a 1 in 200 chance that they'll earn the huge rewards. So what you really got to do is you got to sit down with the decision maker, get from them what their controls are. How do they think about sizing a position? Because somebody could walk into a position that's they could put on a position that's a cost basis 200 basis points of their overall book, 500 basis points of their overall book, and it hits and it winds up becoming 50, 60, 70% of the overall book. But then their value at risk is huge. So internal risk management it's going to really be kind of like the DNA philosophy of that manager in terms of, are they letting it ride? Do they explicitly say in their investment mandate, in their investment policy, that they are going to let it ride and they're going to allow large amounts of volatility in the portfolio? The problem, again, I think the problem is you got to isolate out, where are they getting their ideas from? So on the distress side, we are awash with new distress manager launches. We started interviewing some distressed managers 2 years ago. These are guys spun out of, think of the like 3 largest distressed famous shops. And these guys, ran a desk there, ran a book there. But now the world is awash with distressed managers. And they might have been at a big bank. They might have been at like kind of a long only shop, or they may have just been, convert ARB guys that have been through a couple cycles. But you've got to see that they are, do you want to be the bid beneath the market when paper goes from trading at 95 down to 75 and they just buy it up? Or do you want to be in the distress space where the guys can actually run a bankruptcy process, run a restructuring process? They could go out and find the, what's called a fulcrum security and really get those outsized gains like the Elliots have been able to do in the past. So you got to really kind of go through and really interview and grill them in terms of what their process is for where they're sourcing the ideas, what opportunity set are they actually targeting, because distress it's open to a lot of interpretation. And I think that's really critical. Have they run bankruptcy? Have they had bankruptcies fall in their lap and restructurings fall in their lap? Or have they gone out and have they sought them? Have they sought to be the exit revolver, the debtor, and the dip financing piece?
Thank you,
And
Matthew.
I think that's critical.
Touch there because I see Julia's here and your team is all set coming up, and Marty's ushering them in here, so the long cane is out. So I think that the primary message that I got from today's panel was really back to old school tactics on doing your due diligence and really making sure and taking your time now that you have the luxury of time to take on these opportunities. I want to thank Peter. I want to thank Carol. I want to